All right, let's jump into this deep dive. Today we're getting into the nitty-gritty of algorithmic trading. We've got some pretty cool documents here from someone who seems to know their stuff, a real quant type. They're taking us through how they actually build and test their trading strategies. So I'm pretty excited to see what we can learn from this, especially since you're trying to get a better grasp on how these algorithms work in practice.
Yeah, it's pretty rare to see this level of detail. Most of the time we're stuck with these theoretical explanations. But here we're looking at actual code snippets, decisions, even some of the challenges they ran into. It really feels like we're getting a glimpse into the mind of a quant, you know what I mean?
Like we're cracking open the blueprints to a trading machine. The first strategy they dig into is called break high. So I'm assuming that basically means buying when a stock goes above its recent high price.
Right on. Trying to catch the start of an upward trend. But what's really neat is how they refine the basic idea with their code. They've got this variable market class, which basically groups stocks that are similar. They started with a 3x3 grid 9 categories. Yeah. But then they ended up going to a 3x2 grid, which is a little unusual.
I wonder why they made that switch. Too much going on with 9 groups.
It all boiled down to the data. Some of those original categories had so few trades that the results were kind of shaky. Imagine trying to predict sales based on like 3 days of data. It wouldn't be very useful.
Yeah, that makes sense. But why 3x2 specifically? Is that a common grid size in these types of strategies?
There's really no set rule. Probably came down to how much data they had for each stock type and how specifically they needed to divide things up for this particular strategy.
So it's about finding that sweet spot, right? Having enough data in each group, but also making sure the groups are actually different and, actually mean something.
Exactly. And you see that same kind of balancing act throughout these documents, like in how they handle stops, those automatic safeguards that sell a stock if it drops below a certain price to limit losses.
Yeah, and it's interesting. They seem to really think a lot about this one part of the algorithm. I would just assumed it was just, a simple percentage, set it and forget it.
It's way more involved than that. They focus on 2 main settings, exit at stop and activate stop immediately.
Okay, so what exactly do those settings control?
Exit at stop is all about when the algorithm sells once it hits the stop loss. So it can either sell right then and there, what's called intraday, or wait until the next trading day. Which option is best really depends on how you trade.
Yeah.
And a big thing is what your broker allows.
So you have those real-world limitations coming into play.
Oh, absolutely. And that second setting, activate stop immediately, determines if the money from a stop-loss sale is available to reinvest right away. Sometimes your broker might hold on to those funds even if the sale happened that same day.
So it's not just about riding those upswings, but also being smart about risk and understanding your broker so the algorithm actually works efficiently. It is making me realize just how complicated all this is.
It's definitely a lot more than just plugging in formulas. Now, another strategy they dig into is trend following, which is about, riding the momentum of an existing trend.
So like surfing, you're not trying to create the wave, you're just trying to ride it for as long as it lasts.
That's a great way to put it. They use this indicator called MAPACD, stands for Moving Average Convergence Divergence, to help spot these trends. But what's interesting is they also incorporate a span when they're looking at how price interacts with the MAPED.
A span, what's that, like a time window they're looking at?
Exactly. So instead of reacting to every little blip in the price, they're trying to find those more sustained movements, kind of like using a moving average to smooth out the noise on a price chart. So you're not getting jerked around by all those little fluctuations.
So they're looking for bigger shifts in the momentum, not just chasing every tiny wiggle.
Yeah. And it suggests a more calculated approach, not just jumping on any apparent trend. Speaking of being methodical, you've been talking about simulations. What exactly are those in this context?
As far as I can tell, simulations are basically like test runs of their strategies using historical data.
Like a flight simulator, right? For traders.
Exactly. Before they risk any actual money, they can see how their algorithm would have performed under different market conditions, but in the past. In these documents, they're not just using simulations to see if the strategies would have made money, but also to see how sensitive they are to little tweaks, like different stop-loss levels or that MACD span we talked about.
So it's not just about potential profits, but how tough the strategy is, how well it holds up under different market scenarios.
Absolutely. You don't want an algorithm that just falls apart if one little thing changes. You want something that can handle those inevitable market ups and downs. like building a house to withstand an earthquake, not a light breeze.
That's a great way to put it.
So we've got a sense of how these algorithms are designed and tested in a safe environment. But the big question is, do they actually work in the real world?
That's the million-dollar question, isn't it? And these documents actually give us some clues on how they figure that out. In the part of our deep dive, we'll explore those metrics they use to measure performance and what they've learned from backtesting their strategies.
Okay, so we're back and ready to dig into the results. We've seen how these algorithms are designed and tested in that simulated environment, but now we got to see if they can actually handle the real market.
It's like taking a car for a test drive.
Yeah.
After you built it in your garage. Might have the fastest engine, the coolest features, but it's all theoretical until you hit the open road.
Exactly. And in trading, the open road is measured by specific metrics. What are we looking at here to gauge how effective these strategies actually are?
One of the key metrics they use is CAGR, compound annual growth rate. It basically tells you the average annual return you would have gotten over a specific period.
So it smooths out the ups and downs and gives you a clearer picture of that long-term performance.
Exactly. And what's really interesting is the document doesn't just give you a CAGR number and leave it at that. It actually gives you some insights into what CAGR ranges are typical for similar strategies. Like for the break high strategy, a CAGR of 15 to 20% would be considered pretty good. But anything above 25% would be exceptional and might warrant a closer look.
So they're not just looking at those raw numbers, but actually giving context and comparing to industry benchmarks. That's really helpful for understanding how these strategies measure up.
Absolutely. And alongside CAGR, they also look at max drawdown, which is basically the biggest peak to trough drop the strategy had during the backtest period.
So CAGR tells you how much you could potentially make, while max drawdown tells you how much you might lose along the way.
You got it. It's about understanding that potential downside risk. And the interesting thing is that the creator of these strategies seems to be more focused on keeping those drawdowns low, even if it means a slightly lower CAGR.
So it sounds like they're playing it a bit safer, aiming for consistent gains rather than trying to hit a home run and risking big losses.
Exactly. It's a trade-off. And the document even points that out directly. They're not just chasing the highest returns, but a balance between growth and risk.
Makes sense. It's like choosing between a roller coaster and a scenic train ride. The roller coaster might be more exciting, but the train's probably a smoother, more enjoyable experience.
That's a great analogy. Now, another interesting detail from the document is about something called market class merging. We talked about this earlier.
Right. That was combining groups of similar stocks to potentially improve the strategy. What did they learn about this?
They actually found that merging certain market classes really helped improve performance, both in terms of CAGR and max drawdown. But the interesting thing is they didn't just randomly combine groups, They used a mix of those quantitative metrics and their own understanding of the market to make those decisions.
So it wasn't just blindly crunching numbers. They actually used their knowledge of the market to guide the process.
Exactly. Like they mentioned looking at things like correlation between groups, how closely their prices tend to move together. But they also considered factors like sector similarities and overall market trends to make sure the merged groups actually made sense.
That's pretty neat. Even in algorithmic trading, human judgment and market knowledge are still super important.
Absolutely. And this human element also pops up in how they adjusted the span in the trend following strategy.
Yeah.
Remember we talked about how the span affects how sensitive the indicator is to price movements?
Yeah, shorter span makes it more reactive to short-term trends, while a longer span makes it more focused on those longer-term trends.
Right. And through their testing, they found a span of 3 or 5 days worked better than the original span of 10 days they were using.
So they're making it a bit more nimble, able to catch those shorter-term trends, but wouldn't that also make it more likely to get caught up in random price fluctuations?
Yeah, that's a valid point. And the document even mentions that trade-off. But it seems like they found a good balance where they can grab more of those shorter-term trends without drastically raising the risk of getting shaken out of winning trades too early.
It's like fine-tuning a metal detector. You want it sensitive enough to find the good stuff, but not so sensitive that it's beeping at every little piece of junk.
That's a great analogy. Now, another important thing they bring up is the impact of those those transaction costs.
Right, those pesky little fees that eat into your profits.
Exactly. And what's impressive is they're not just accepting them. They're actually looking for ways to minimize them.
How are they doing that? Are they using a specific broker with lower fees?
That's one way. But they're also trying to optimize the algorithm itself to make fewer trades. Instead of jumping in and out of positions all the time, they're trying to be more selective and only trade when the potential reward is really worth it, compared to those transaction costs.
So it's not just about finding winning trades, it's about making sure those wins are big enough to cover the cost of actually doing business.
Exactly. And this attention to detail is really impressive. They're not just focused on theoretical performance. They're actually looking at the practical side of trading and finding ways to optimize accordingly.
It's the difference between designing a race car on paper and actually building one that can handle a real track.
Exactly. And this leads to a really important question. How do we know these results aren't just a fluke? How can we be confident that they'll hold up in the future?
That's the big question, right? Backtesting is great and all, but it's all based on past data. How do we know these strategies won't fall apart when they're faced with the unpredictable nature of the market?
That's where the idea of out-of-sample testing comes in. It's like the ultimate test of how strong a strategy is, and it's what we'll explore in the final part of our deep dive.
All right, so we've talked about backtesting and how these strategies did with historical data, but how do we know they're not just flukes? How can we be sure they'll actually work in the crazy world of the real market?
That's where out-of-sample testing comes in. It's a way to check a strategy by testing it on data it's never encountered before. Mm-hmm. It's kind of like giving a student a pop quiz on material they haven't studied. A real test of whether they actually understand it or if they've just memorized the answers.
So it's not just about whether it could have made money in the past, but if it can actually potentially work in the future.
Exactly. And the really impressive thing is these documents actually include out-of-sample testing. They didn't just backtest and call it a day. They went that extra step to see if their strategies could work on new data.
That definitely makes the results more believable. But how does out-of-sample testing actually work? Do they just pick random dates and see how it did?
It's a bit more organized than that. Usually you set aside a chunk of your data as the out-of-sample period. Say you've got 10 years of data. You might use the first 8 years to develop and fine-tune your strategy, and then keep the last 2 years for out-of-sample testing. That way you're kind of simulating what it'd be like to trade the strategy in a totally new market environment.
So like fast forwarding to the future and seeing how it would have done in a period it never saw during training.
Exactly. So what did these out-of-sample results tell us about the strategies? Well, that's where it gets really interesting.
Okay, lay it on me.
The document shows that for the most part, the strategy still performed well in the out-of-sample period. The KGRs were a little lower, which you'd kind of expect in a truly unknown market. But those max drawdowns stayed within reasonable limits.
So they passed the test. They weren't just overfit to that historical data. It seems like they actually picked up on some real market patterns.
Exactly. However, there were a few cases where some strategies didn't do as well in the out-of-sample period compared to their back-tested results.
So even with out-of-sample testing, there's no guarantee of perfect performance. The market can still surprise you.
Absolutely. And this is where the human element is so important. Even with fancy algorithms, someone needs to be watching the systems, interpreting the data, and making adjustments as needed.
So it's not just about setting up the algorithms and letting them run on autopilot. It's about combining that automation with human judgment.
Exactly. And this brings us to a final takeaway from these documents, which is the importance of constant improvement. Mm-hmm. They really emphasize that algorithmic trading isn't a one-time thing. It's a continuous process of testing, refining, and adapting to the ever-changing market.
Like tending a garden. You plant the seeds, you give them the right conditions, but you still gotta water, prune, and adjust your approach based on the weather and how the plants are doing.
That's a perfect analogy, and that's what these documents show us so well. They're not just a set of instructions, but a living record of a quant's journey, their experiments, their insights, and that ongoing quest to really understand the market.
This deep dive has been really, really insightful. We've gone from From understanding how algorithmic trading works at a basic level to exploring the ins and outs of back testing, out of sample testing, and the importance of human oversight, I feel like I have a much better grasp on the complexity and the potential of this whole field.
It's been great sharing this journey with you. And as we wrap up, I'm left with a thought-provoking question for you, our listener. We've seen how these strategies were designed, tested, and evaluated, but the real test is what happens next in the ever-changing market. So you continue to learn about this world. Think about this: what new challenges might we see in the coming years? And how will human ingenuity and tech continue to shape the future of algorithmic trading?